Joining us now is Mark Fields. He's the former CEO of Ford and a CNBC contributor. Mark, it's great to have you on. I've been doing this a long time. I've kind of learned that you can only kind of make educated guesses about what actually animates Tesla shares. And obviously, if the faithful just get excited about something, of course, coming off a really bad quarter, the stock has recovered a fair bit. But what's your read on this matrix of factors that could be influencing Tesla sentiment right now? What seems at work?
Well, Michael, you're exactly right. You know, with Tesla, the fundamentals don't really apply to that drives the stock. It's really a number of other things. And I was thinking about this the other day. An analogy is it's like, you know, Tesla's stock price and their market cap. It's like going on a Tesla road trip, right? It's fast, it's thrilling, it's a little bit unpredictable, and it sometimes has to go down to charge for a while. And when you think about the things that are driving the stock, literally since the earnings call a couple of weeks ago, is, you know, one is market sentiment. Second is what's happening with trade and tariffs. And we saw today, you know, Trump making some comments before the Secretary of the Treasury meets with the Chinese officials this weekend. That could put a positive spin on it, because although Tesla produces all of their vehicles for the U.S. here in the U.S., they still import a number of important components from overseas and from China. So anything that goes down on the lower tariffs would help Tesla. I think also Musk's return to the White House, or return from the White House to spend more time, more focused time on Tesla, is energizing investors. And then finally, it's their big bet on robotaxis. They confirmed in their earnings call last week or the week before that they were on track for a summer launch. And, you know, that could be very big for them, or it could not. So I think those are the things that are driving the stock these days.
Yeah, robotaxi could be big for them, but the anticipation of robotaxi is more likely to be good for the stock than not. It's usually the pattern with Tesla. And I guess even just the idea of, you know, less hostile posturing between the U.S. and China probably is better for Tesla than not, given its importance of that market to Tesla. You know, more broadly here, we're talking about, you know, lots of differences between different manufacturers and how they might be impacted right now. We also heard after the UK deal was struck yesterday, which is going to basically, you know, allow UK automobiles into the country with a lower tariff rate than many U.S.-based manufacturers will be able to you know, deal with, just because they're content made in Canada and Mexico. Is this sustainable to have all these different sets of rules?
Well, first off, it's very complex, right? So you're going to have the management teams of these automakers spending a lot more time, non-value-added time, for either the product or the consumer, figuring out these complex tariffs. But I think in the case of the UK-US, at least framework that they announced, this is not a good template for, let's say, the Detroit automakers, because, as you said, you literally could now import a UK automobile, let's say a Range Rover that has, you know, very little U.S. content, cheaper than you can for a vehicle made in Mexico that meets the USMCA agreement and maybe has 50% U.S. content. So that is not a good template for countries like Japan and, in you know, case of South Korea, Hyundai and Kia. That could put them at a huge competitive disadvantage with the domestic OEM. So it's not a great template. It's a good deal for the UK. You know, I'd put it as, you know, the US and UK just, you know, swap the slow lane for the HOV lane with, you know, less tariff traffic and, you know, more collaboration. But there's going to have to be different constructs. And to your point, it's just going to be very, very complex.
Meantime, quickly, Mark, I mean, the company's dealing with all these challenges, and yet sales activity has been pretty good, better than expected. And I guess a lot of that is just people getting in front of it. You're seeing used car prices also go up. So maybe that's a cushion for now?
Yeah, it's probably a cushion for, you know, just a period of time, right? We saw the market get juiced in March and April. The seasonally adjusted selling rate went over 17 million units in both those months. That's the first time it's done it in, you know, a number of years. And I think a lot of that was people just rushing to buy pre-tariff vehicles. You've seen that in, as you said, used car price residuals going up. But I think you're actually starting to see that fade in, you know, the early days of May, where, you know, inventories are starting to come down. They're down about 10% month over month. But I think it was a little bit of a sugar rush of sales and a little bit of pull forward, and the industry is going to pay a bit of a price for that.